Taher, good morning. Thank you for joining us. Hope all's well and everything is fine with you. Taher, the first thing which is coming to everyone's mind is that the news on the medical front is getting better, but the markets have just not reacted to the second wave. Why are markets getting complacent? Are markets looking through what is happening, what's happening because of the second wave in terms of demand impact and also the economic impact?
A couple of reasons for this, Nikunj. One is clearly that we've the element of surprise, which was or negative surprise, which was there last year when the virus first broke out, the pandemic first broke out. That element of negative surprise this time around is not as much because over a period of the last 1 year, people have in general got acquainted with the problem at hand. It is while of course it has got a little worse, much worse in the second phase compared to the first one, but there is greater amount of familiarity with respect to how to control, probably what kind of measures to follow, protocols to follow in order to be able to get over this. The fact that we are probably not following as much of it is a different issue, but we know what to do in order to kind of get this thing under control. The second, of course, is the fact that, this time around the lockdowns are not as severe. Obviously, the government has made it very clear that they don't really want to go in for complete lockdowns. So there is a good part of economic activity which is still around and kicking, especially the ones which are not associated with social distancing. The third is, of course, the fact that we've seen the evidence of the vaccine rollout in some of the other countries and their ability to having control the second or the third waves out there. And I think year two, of course, India has lagged, but clearly I think many of the initiatives of the last couple of weeks, which have been forthcoming, as we all know, seem to suggest that vaccination will pick up very materially in the next 3-4 months. Our view is that within a year's time or probably less, we could get to 70% or more of the eligible population to get vaccinated, at least one dose, and there could be 20-30% of it which might even have gotten to 2 doses. So I think all these things therefore have not necessarily evoked the kind of panic reaction one would have thought on account of the second wave.
Taher, how exactly do you think one should propose one should now approach the market now? One option is that you buy the bad news. Second option is get realistic and hunker down expectations which had got built up in the month of Feb and March, where everyone thought that the economy will only go one way, demand will remain strong, and the earnings surprise will continue. Is it time to buy the bad news or time to hunker down and bring expectations to realistic levels?
I think do both. Buy the dips, buy the bad news. Simply because, like as I said, the compression of economic activity will not be as much as what we probably saw last year, and on account of various factors that I mentioned. The other is that you keep your expectations reasonably, under control. I mean, you can't expect the kind of returns that you got in the last year to follow through in this year as well, because there is a fair bit of momentum or valuation catch-up which has happened in the markets. I wouldn't therefore want to say that the markets are extremely overpriced or any such thing, but they are not of the discount that we probably got last year, and therefore if one were to see year-on-year gains of 70, 80, 90%, obviously that is not something that we should not even probably think of 30, 40%. I think if we can revert back to trend returns or mean revert to more average returns somewhere in the vicinity of between 10 and 20%, I think that is the expectation. If you have to go with, then you are okay, good to go, even in buying the dips. So I would say buy the dips, buy the bad news, but keep your expectations within control.
Taher, would you stock up further on defensives or would you go deeper into cyclicals right now?
Well, I think the cyclicals make a little more sense to us, given the impending recovery, not just in India, but even globally, whatever is already happening. In fact, global cyclicals are probably even better positioned for the very near term as well, given that India will probably face a little more challenge over the next maybe a quarter or perhaps a little more than that. To get the consumption part of the economy going. So I think cyclicals, I think industrials, maybe financials for that matter, some of these value plays look to us to be places where probably there is more money-making opportunity at this stage. Also because some of these spaces have seen some reasonably decent cuts in prices in the last couple of weeks in the correction of the market. So while optically the market may have just corrected about 5 to 6% from its peak, but many of the stocks have corrected a lot more, as we know. So I think our focus would be on, and especially banking within that has corrected quite meaningfully. So I think that is where we would probably spot value. So basically, I'm looking at areas like financials, industrials, certain global cyclicals and commodities. These are the places to our mind look a little more holding out a lot more promise at this stage. I think consumption related will probably take a little bit of time to come back. We've not seen as much of a correction out there, and valuations to begin with have not necessarily been the most easiest out there either. So we are trying to kind of increase the value component of the portfolio in many of our strategies.
Okay, fair enough. So that seems to be a pretty clear strategy going forward as well. Would you again stick to the frontline names in these pockets, Taher? I'm just asking again from the point of view of, mitigating risk at this point, or would you also be willing to look further for select opportunities in the broader markets?
Well, we are absolutely agnostic at this stage. I don't really think we have any great preference over large cap, over mid and small caps. I mean, whatever comes to the table which makes sense to us. Maybe we are finding probably more opportunities in the broader market. So perhaps from that standpoint, maybe mid and small caps look a little more attractive. But we are not necessarily averse to buying large cap stocks if we see value out there as well, and especially in some of the sectors that I referred to earlier. So we are not cutting it across market cap at this stage, and I think we are not trying to be defensive either. I mean, we took a stance since the beginning of the year that we likely to see a economic recovery, howsoever modest it might probably be, at least in comparison to the last couple of years, we should be a little better off. So we of course the second wave has hit us, and that has kind of interrupted this journey for a while. But we think that somewhere down the line this is going to subside. The pandemic will abate because of the reasons that I mentioned, and also the fact that the infection rate has gone up meaningfully, but the government response, despite being delayed, is now really very strong, and therefore probably the rate at which infections would come down also would be as high as the rate at which it went up. So all these things make us believe that we are still on course to get that economic recovery objective that we have in mind, and therefore we are positioning ourselves from that standpoint. Within that, do we need to fine tune? Like as I said, yes, we probably need to give a little bit of backseat to consumption-related stories at this stage. People-centric, consumption-centric businesses will probably take a little bit of time to recover. Probably early next year, as soon as we have got a large percentage of our population reasonably covered, and that would bring face-to-face businesses back in action. But up until then, I think some of the others, industrials, etc., probably make more sense, which are not necessarily constrained on account of the present situation.
Taher, do you think that the second wave is really going to challenge the prospects for the capital goods sector? We had seen the labor availability hitting pre-COVID levels. By and large, there was a ramp up in execution across sites. There was, timely disbursements of payments. Things were really looking up. What does the second wave mean now for the entire capital goods space?
Well, I think I don't really have stats to support it, but anecdotally, evidence does not really seem to this time around suggest that there is a lot of migration, which is reverse migration, which has happened like we saw in the first round. And I think even after the first round of migration that we saw last year, I think the comeback was quite quick, and economic activity resumed pretty fast, as we all have seen. I don't really think the dent this time around on in capital good related activities or infrastructure related activities, as I said, is going to be very very deep. I think it'll be a reasonably shallow impact in my view as things stand today, and if assuming what we are expecting works out and pans out in the next few months, 2-3 months. Where I see a little bit of challenge for sure is smaller businesses, mid-size, small-scale industries, because small retail, because that is the place which gets hit all the while. I mean, whether it was in the first wave of the pandemic or the second, that has always taken the beating. So what is quite clear, unfortunately, though, is that whether it is a limited period lockdown or a prolonged lockdown, some of these very unorganized kind of businesses or retail-oriented businesses will be the ones which will take probably the most of the brunt. And maybe that is something which in the near term, medium term might probably benefit some of the larger enterprises as an organized to organized shift therefore accelerates. But it might probably lead to a bit of a long-term problem as well, because that is also a segment which imparts a boost to consumption. So it's unfortunate, but that is where the largest part of the pain of any of these lockdowns have generally been observed.
How are you playing the entire tech and digitization theme? Is it by some of the pure play IT names? Would you look at the recently listed Nazaras of the world? And what would be your view on how one should bet on this for the long haul?
I think most of our choices, of course, from the point of view of available opportunities, revolves around the IT services, the pure IT services space. That's what we largely have in India. There are one or two of the tangential ones, but not really much to speak about, whether in terms of breadth or in terms of size. And there are a couple of the ER&D related, IT services which we like. So it's a mix of that. We've kind of been overweight IT for the last probably about 2 to 3 quarters for sure, and it's worked out quite well. We still find with it. I mean, the thing is that only thing is that in this correction of the market or in this weakness of the market, tech is not necessarily corrected as much, and therefore when we try to look at opportunities or places where there has been some value erosion or prices have come off, we would like to use some part of tech to rotate into some of these opportunities on the industrial side or on the cyclical side. So I think we are there. But maybe at some level we have kind of reduced a little bit of our overweight as far as tech is concerned. But they're still good to go. They have provide a reasonable amount of visibility of earnings at least for the next 12 to maybe 18 odd months. A reasonable amount of business intensity in terms of deal wins, etc., across some of the companies that have reported up until now. So I think they're still good to go, but we have probably cut a little bit of our overweight over the last few weeks probably.
Okay, I'm just going back and let me look at the screen now. What is the big mover today? It's Reliance. Now, be rest assured, when Reliance moves and when banks are stable, it will be a good day for the Nifty. So it's turning out to be an okay day for Nifty. Taher, I want to go back to the metal part, because right now it's like Behti Ganga, if I may use the terminology. Everyone is trying to make hay when the sun is shining. But there would be a price point at which either auto companies or the consumer or the consumer durable companies or the consuming industries would say, look, we cannot afford this kind of a price hike. How far are we away from that point?
Well, I think we've seen some response of even the steel consumers, the consumer durable companies or the auto companies with regard to price increases over the last maybe a month or two. Since, let's say, the start of this calendar year. So I think it has come by at a time when demand is kind of been a little sluggish. So I think there will be a little bit of pressure to, keep increasing prices in response to the underlying increase in steel prices. So there's no such point as such. I think steel companies will pass it. Steel companies will price what they have to price, what is available in what prices are prevailing in the market. It is a question of what the consumption-related companies or the steel consumers actually do with it, and what is their end demand. And I think some part of that pressure will probably be borne by them up until at least the time that demand on the consumption space doesn't come back. Like as I said, consumption will probably take a little bit of time. I think there will be a bit of a psychological impact also in terms of consumption demand as soon as we come out of this lockdown, given the intensity and the way this second wave has been for all of us compared to the first one, in terms of casualties and so on and so forth. So I think there will be a psychological impact around this. And that will mean that durable companies or auto companies will find it a little more time consuming before they are able to recoup all of this. So that is how we'll have to therefore play it out. So it is, for now, it is advantage steel companies. It is probably some bit of disadvantage as far as the buyers of steel is concerned.
Do you like any of the so-called new age themes, EV, clean energy, buy ethanol cycle, buy battery companies? These are the go-to pockets right now, and why not, Taher? Because we all are headed towards an era where energy is going to be clean. There would be more dependence on gas and other alternates. There is going to be an EV acknowledgement which has now come in the world. How are you betting on these new themes?
Well, they are compelling themes, and we've tried to represent them in our portfolio in whatever way possible. Simply because we don't really have too many plays around it as yet in India. There are some of them which are emerging. We found some of them in terms of utilities, wherein we can represent a little bit of the green energy plays. We've got a couple of the auto components or certain technology companies which have probably recently listed. There are one or two which are in the offing, which offer that opportunity, provide that opportunity. So we don't really have a very vast set at this stage, but we've tried to play it largely through utilities and some of these very individual bottom-up scattered industrials or material-related companies.
Funds cannot go short. That's not the mandate which you run. But if you have to sell something because you think the stocks either have peaked out or they do not justify this kind of a price multiple, where would you say, look, it's time to lock out completely? These are good companies, but I don't like either the valuations or I'm not very comfortable about the future growth.
Well, I think right now, in terms of, we typically follow a balanced approach to our portfolio. So we try to make sure that we represent decent businesses across a wide variety of sectors. Where we are clearly underweight at this stage is FMCG. That is not something that we have a lot of at this stage. We have been a little neutral to marginally now underweight as far as telecom is concerned. Besides that, I think, like as I mentioned, more recently we've cut back a little bit on our tech exposure, but barring which, I think we are broadly well represented across. There are opportunities across. There is no such space where we are completely out of it. If I were to say so, there are certain compelling opportunities, whether it is in pharma, whether it is even in FMCG. We are underweight, but it's not that we are zero out there. So same goes with oil and gas or financial. So I don't really have a sector to say that this is something which is a complete sell at this stage.
Are you playing it safe, or you're genuinely able to spot opportunities in every sector? Because Taher, we all know the importance of avoiding sectors, which is that if you, let's say, bought a consumer company between the 2003-2008 bull market, you never made money. If you avoided any infra company between 2013 and 2018, you actually saved money. And if you bought any consumer company between 2003 and 2008, you made a lot of money. So the point I'm trying to say is that does it make sense to follow a diversified scheme when we know that sectors and cycles do play a role?
Well, at one level, Nikunj, I can even throw back the same thing at you in saying that there has not been as much of sector rotation as what we've probably been used to maybe 10 years ago. I think within sectors we've seen a lot of divergence rather. Sorry. I'll say, let's say in FMCG we saw one or two companies in the last 5-6 years do exceedingly well compared to the others, and we saw oil and gas. Oil marketing companies probably did very well between 2013 and 2017, and some of the others did not. And then came 2017 to 21 when some of the upstream oil and gas companies did exceedingly well, and the oil marketing companies didn't do anything for that matter. We've seen, of course, the classic divergence between private sector and public sector banks within banking itself. So we found more, even in autos for that matter, we've seen sometimes two-wheeler companies do well, sometimes the four-wheelers have done well, and so on and so forth. So I think it has not necessarily, probably to my mind, I don't think it has made a lot of sense to stay out of one particular sector, lock, stock and barrel. It is probably, there has been, bottom-up opportunities in every sector. Because business cycles have been a little different. The company business cycles have been probably a lot more prominent this time around. And if you've caught that right company business cycle, corporate cycle of a particular business, then I think that's worked out quite well as a strategy from a portfolio standpoint.
All right, Taher, thanks so much for joining us this morning and sharing your current outlook with us.